Hello everyone. This Friday we have kept a different time for this webinar. Generally we do 4 to 5 because our speaker was available only on this time. Thank you so much, first of all, Aniruddha, for giving your time. Any other Friday, today we are wanting to discuss and share knowledge and also obviously understand on the topic, which is to understand how has been so far Q1 earnings, and obviously what are the expectations. You come from equity research background, and obviously as a fund manager I'm sure you're closely watching what are the kind of numbers that are coming, and that is exactly what we want to discuss this, plus obviously a broad expectation of equity markets in 2025, which is being laid with the foundation of these numbers and other macro factors. For the audience, Aniruddha, is a dear friend and has 2 decades of experience in equity markets. Currently, he's CIO with Quest Investment Advisors. I have had a fortune of doing interactions with him way back in 2019 when we had started, and we were like, we were nothing. But today we manage more than 1,800 crores of assets, and by end of this quarter, hoping to cross 2,000 crores of assets. But coming back to the topic of our discussion, Q1 earnings so far, expectations, and way ahead for equities and markets in 2025. You can maybe give your opening remarks, Aniruddha. Welcome formally to this platform again, and then we'll move on. We'll kind of keep it interactive. You just give your opening remarks, and then we'll move on.
So thanks, Kamal, for having me on your platform. And as you mentioned rightly, it's always been a very exciting discussion whenever we have a discussion on your platform. And the idea, what we always say, is to give more honest and practical opinion, and not just to go by the book, because market works only on practical kind of a knowledge. So having said that, I would say that obviously investors have been asking various questions, and I'm sure all the attendees on this call and also your investors would be having the same kind of questions, that where are we headed from here? Because after seeing whatever has happened, in fact, if you see, like they say rightly, there are times when nothing happens for months or years, and there are times when everything happens in a couple of weeks. And I think first 6 months of this year, we have just completed 6 months, and I think we have seen everything from sharp correction in the markets to war, to interest rates being cut by 100 bips, to Mr. Trump coming to the White House imposing obnoxious kind of the tariffs. We have seen practically again everything in the last 6 months. And where are we? We are already around, if I talk about the headline index, we are around 5-6% higher from where we ended the year, the last year. So I would say that before I come to the earnings, I'll just talk about a couple of the macro things, which is, I think, going to impact the earnings, because ultimately earnings are an outcome of what is happening around us. Now, if I look at some of the macros which are there, which is going to impact the earnings, and I think a good glimpse of that is evident in this quarter numbers, which has already come. Most of the numbers which has come so far is all in the IT sector and a couple of the banks. But IT sector is again a good indication of where things are going to be headed from a macro perspective. So if I just look at some of the factors which were the major drivers for the market in the last 6 months, one big factor was what will be the impact on the tariffs on India's corporate earnings. And I think broadly, if I say that is something which we can ignore, because there is not going to be any direct impact of the tariffs on corporate earnings in this quarter. We are yet to come out with the India-US deal, and I think how that shapes up, we'll have to see. But one thing is very clear, India definitely will have a better deal compared to most other countries, what they have got. Second big factor, which was a big concern for corporate earnings, was again on the geopolitical conflict, that what will be the impact of war in Middle East on oil prices, because oil is a very big factor when it comes to India's corporate earnings. There are many companies which are linked to oil as their input material. You have the biggest company, which is Reliance Industries. Gross refining margins for Reliance makes or breaks the profitability numbers for them, and that definitely has an impact on the broader market. Apart from that, India's import bill also moves up and down depending on how oil is priced based on what is the conflict happening in the Middle East market. On that front, I think most of the wars which could impact oil, they are over, whether it's Iran-Israel or Israel-Palestine or our own war on our front. with the Pakistan. I think that is comfortably below the price level, and I think oil is again not going to be a major factor when it comes to earnings impacting. The third big factor of what was a factor which could impact earnings is the interest rate, because interest component is a large component for many companies. But thankfully, in the last 4-5 years, we have seen the leverage declining for practically every Indian corporate. And I think in the last 6 months, RBI has surprised the market with almost 100 bips cut in the CRR and 100 bips cut in the repo and a 150 bips cut in the CRR. And that is definitely going to again show positively on the interest payout component for most companies. And I think going ahead also you'll see the interest burden being very low for most corporates. What else was the major driver for the earnings? One was the liquidity factor. I think RBI has done an excellent job there. They've infused a lot of liquidity in the ecosystem, and I think that definitely it goes well for both corporate earnings as well as for the equity market. And the last factor for the impacting the markets was the domestic and the FI flows. I think FI flows, which were on the negative for most part of the last year, is doing pretty well after the Jan, Feb, March decrease which happened. So between Jan to March, there was almost like a $16 billion of FI outflow. From April to now, which is April, May, June, we saw roughly around $8 billion of FI inflow, which means from January to now, you have a net outflow of roughly around 8 billion. But I think that's pretty good compared to how the fear was that, you'll see an FI outflow continuing from India. So broadly, I would say even on the liquidity front, on the flows front, FIs continue to be good. Domestic flows have been the big support for the market for the last 4-5 years. They have not disappointed, except for 1 or 2 months in beginning of this year. I think where we stand today, domestic flows continue to be very, very strong as we are there today. So I think all these factors are going to be very supportive for earnings where we are and where we are headed. Now, if I just talk about the headline earnings numbers from a broader perspective, I'll get down to the individual sectors maybe subsequently as we discuss. But if I look at a broad line headline numbers for index earnings, post-COVID, India was blessed with mid-teens to high-teens kind of an earnings growth. We were like accustomed to seeing 15-18% kind of an earnings growth for India Inc. And rest of the world was growing at mid-single digits to high single digits. India was growing at mid-teens to high-teens. FY25 is the big year wherein a lot of the resetting happened. From growing at mid-teens to high-teens, we saw the earnings come off to the mid-single digits kind of a number. And that was a big shock, which I would say it led to the last year's major underperformance for India as a market. If I talk about FY25, definitely India did, I would say it did not do so well in the second half compared to the rest of the world. And that was purely because of the earnings degrowth which happened. So FY25, which was, I would say, kind of a washout year for India on the earnings front, we had a 5-6% kind of an earnings growth. Now, we have entered FY26 in the first quarter with a lot of hope that this quarter is going to be kind of the inflection point for the earnings pickup to happen. Now, my confidence is that this quarter we will not see a big surprise on the earnings growth. You should see a similar 5 to 7% kind of an earnings growth, could be in the range of 6% plus minus. I'm talking about the Nifty earnings growth. If I talk about the broader market slightly, maybe the BSE 500 or NSE 500, you should again see a 6 to 7% kind of an earnings growth for the headline index in this quarter. But I think this is an inflection point because post this quarter, a higher growth is expected in the second quarter, much higher in the third quarter, and a much higher in the fourth quarter. All this is coming purely from a base effect because last year, if you see, first quarter was okayish, second quarter was horrible, third quarter was equally bad, and fourth quarter was a decent pickup. So I would say part of the growth which I'm seeing in this year, first, second, third, fourth quarter, is partly because of the base effect and also partly because actual growth is also picking up. First quarter, as I mentioned, expecting around 6% plus minus kind of a growth. Second quarter, roughly around 7 to 8% kind of a growth on a Y-on-Y basis. The third quarter, you should expect around 13% kind of a Y&Y growth. Fourth quarter, anywhere between 15 to 16% kind of a Y&Y growth. Full year FY26, we should expect anywhere between 10 to 11% kind of a Y&Y growth, which will be kind of almost like 100% jump from what we saw the last year. 5%, 6% kind of a growth, which was visible in FY25. So this year, you should see almost like a 100% jump from the earnings which we saw the last year. So I would say that the big negative which has plagued FY25 for our market was earnings degrowth. I think that is completely behind us now, and where I think FY26 should be a double-digit kind of an earnings growth for our markets, and that would support the valuations also for our market.
Sure, Aniruddha. So the foremost question, as you mentioned, realistically speaking, from the point of view of investors, what makes you positive? And are there any, I would say, commentaries, guidance, of particularly companies that you can quote, which make you, or you have any understanding of, the action on the ground that kind of makes you feel that yes, the earning trajectory is now on the upward and the downward, thing is reversed?
Yeah, sure. So I think, there are, enough indications. If I look at, the macro numbers, and if I look at the high frequency numbers, which keep coming every month, every quarter, I think that's a good indication that things are moving pretty fast. I'll just give you one number, which will kind of take you through, and then we'll discuss it more. Private capex number, for the first time, the private capex number is more than the government capex number, which happened in FY25 in absolute terms. So in absolute terms, the private capex was roughly around 11 lakh crore. Government capex was around 10.5 lakh crore. So in absolute terms, for the first time, the private capex number is bigger than the government capex number, and this has happened after a long time. But percentage-wise, yes, the government capex growth has been more than the private capex. Now, this is going to translate to many sectors where the earnings growth will be very, very high. Now, where are we going to see the biggest earnings growth in this quarter is again coming from these macro high frequency indicating numbers. It will be very surprising. Typically you don't expect a 25 to 35% kind of a growth in industries like cement, the real estate. But this quarter won't be surprised to see like a 25 to 35% kind of a Y-on-Y growth in industries like cement, the real estate, and capital goods. Now, this is coming purely because where we were last year, if you see April, May, June was an election period. So election period, which was there last year in April, May, June, that was a complete kind of a period wherein infrastructure activity, real estate activity, construction activity, it went down drastically. Now, typically in an election year, that is a very normal thing to happen, wherein you find most of the capex activity being very, very slow. Now, all that got postponed, pushed back. A lot of that happened in the, I would say, the last quarter of FY25, and a lot of it is happening now as we speak. So this is one big area, I would say, the capex. So, and that's the reason if I see in my own portfolio, almost 30% or 1/3 of my portfolio is exposed to the capex cycle. So capex is a big play. This quarter, I'm not just talking about this quarter, or I would say rather whole of FY26. I think capex is going to be a big play which will benefit investors. And within capex, when I say you have the sectors under that, you will have one is your power. Power is a big capex play which is happening. I have almost 18% power exposure in my portfolio, and I think that is one area where government focus continues a lot. So power capex within the capex story, infrastructure, cement, construction, the real estate. So these are big areas of growth which is going to happen. The second big indicator of growth which is going to come is into the consumer discretionary. Now, consumer discretionary is basically, I would say, benefiting, which is going to benefit from the tax benefits which the government has given. Now, all this has started to come into the whether you talk about the bank account or the wallet of consumers from the 1st of April, wherein, you had almost 87% of the last year's taxpayers not requiring to pay tax in this year. Now, this is going to be a large kind of, you can say in this way that, without an appraisal, 87% of these taxpayers got an appraisal, wherein they had a decent increase in their disposable income in their hands. So this is again going to get translated to a lot of consumer discretionary spends, and within that, typically I'm betting on the consumer discretionary spends, which are the low ticket consumption. So I'm not talking about FMCG, that's a different discussion, but things like, you spend more on the weekends, you go out, you eat more, you spend money on holidays. So hotels are doing well. In fact, if you look at hotels, the companies which have reported numbers, the two large players have reported numbers in the last 2 days, your ITC Hotels and Indian Hotel. I think even at this base, they are reporting at 13-14% kind of an ARR growth, which is like definitely something which we need to have a look at, because after growing for the last 4 years, you're still seeing a mid-teen kind of a growth in ARR. That is something which is definitely worth taking a discussion to a different level altogether. Consumer discretionary is going to benefit. Consumer staples, I would say again, that is one area where after almost 11 quarters, growth will be visible, because consumer staples basically is your FMCG and the basket. The rural growth, which was very, very subdued for most part of FY25, I think that is again something which is picking up. The rural, I would say, income has picked up. The rural spending has gone up. Good monsoon across India. Early monsoons, good monsoon leads to good harvest. We all know that. And I think with higher MSP also, I think this will all translate to good disposable income in the households of the agri households. So I think consumer discretionary, consumer staples becomes the second large area where a lot of growth will happen after the capex story. So capex is my biggest growth story, which includes your cement, infra, capital goods, power. Second big earnings growth area is going to be your consumer discretionary and consumer staples. The third area where I see decent growth is the EMS basket, wherein we talk about the electronic manufacturing, and also I would say the healthcare space. So this is going to be the third basket where a decent amount of growth will happen. So these are the areas where I see a lot of growth. Yes, we can always talk about the sectors where growth looks a bit of a big concern.
Absolutely. Let's talk about that aspect, because that's another interesting way to understand, what to kind of watch. So what are those sectors?
Yeah, so I think when you look at the sectors which where you will see the biggest negativity, or I would say most disappointments where will happen, I would say the most disappointments are going to happen in the top overweight sectors. Now, which are the top overweight? I'm talking the top overweight sectors of the index, not my portfolio. Thankfully, I'm underweight on all of those. So the sectors where you will see the maximum disappointments are going to be your IT sector. I think IT is something which continues to disappoint for the last 4 to 6 quarters. I have been underweight on it, and I think it's being proved that Indian IT companies are very, very expensive compared to the growth they are seeing. All are quoting at anywhere between 18 to 30p multiple. Growth is happening at 4, 5, 6, 7%, and stocks are quoting at 20 plus P. So I would say that IT is going to be a big disappointment. Second big disappointment, I would say, will continue to be in the banking space. So IT and banking, which makes up almost 50% of the index, is going to see a lot of weakness. And that is the reason this quarter overall index earnings growth is expected in the range of 6% plus minus. Two big drags will be your IT and the banking. Now, what is plaguing IT, and why I'm mentioning this is that, most people have a lot of exposure to banking and IT. So I think it's a good thing to discuss on these two. So IT, I think Indian IT has been a bit slow in adopting the whole AI revolution which has been happening. And when I see most Indian IT companies, they're still trying to figure out how they can impact their customers on the AI front. Now, that is where a lot of the new age companies, small companies, unlisted space, they are doing a lot of damage to the large players in India, because they have been able to adopt to AI. They are coming up with many new innovative products, a lot of new innovative AI products. And that is, I would say, helping the customers a lot. And one companies is because of certainty around the tariffs, a lot of discretionary IT budgets either have been cut or they have been postponed from most of the large US and European customers. That is again delaying execution of projects. So, we keep hearing about a deal pipeline for the Indian IT companies, but when you look at the execution, that is not translating at an equal pace. So execution of the projects is not happening at the same pace at which it should have happened. So I think that is again something which is continuing to hurt the margins, continuing to hurt the growth for the Indian IT companies. Which will benefit, I think, small companies who are more agile, small companies who have been on the forefront of AI. I think those are the ones which will benefit the most. On the banking side, I would say banks, I think, will continue to see a lot of pressure on the NIMs, because I think the biggest concern in banking sector as of today is the lending growth. Till the lending growth doesn't pick up, I think I think seeing growth for corporate earnings on the banking side is going to be very, very difficult. So the lending growth is something which is the main bread and butter of banks. Until you see a lot of lending growth happening, very difficult for banks to show decent amount of growth. On the other hand, deposits, I think thankfully most banks have cut down the deposit rates. So at least to take care of a bit of the NIM pressure which is there. But I think savings rate, deposit rates need to go down more if the banks have to maintain their NIMs. So I think that is one area where I would continue to remain underweight and want to remain very, very skeptical on picking up before I see a decent amount of valuation correction over there.
Sure. On one side, you had mentioned that you are quite optimistic about the capex-driven sectors, especially power, and on the other side, you are relatively negative on the financials. In my opinion, as per my understanding, both are interlinked, especially the PSU banks, and obviously now some of the corporate-focused, private banks as well. It's like I would say ICICI Bank, which I have seen, maybe you also may have in your portfolio with regards to financial as an exposure. We're not discussing stocks here, but I'm just wanting you to further clarify that why this irony.
No, I think it's a very good point you mentioned, because this is something which typically only a smart investor will be able to catch it the way you identified it. I think where the big disconnect is, and this is a trend which has happened in the capex cycle for the last couple of years. If I see the capex which has happened in the private capex which has happened in the last couple of years, bulk of it has been financed from internal accruals and cash flows. Now, that is what has led to the bank lending growth being very low, because bulk of the capex has been financed by internal accruals and cash flows. This is a common trend across corporate India, that the leverage on the balance sheet has gone down drastically. So with a lot of the leverage going down, cash flows improving, a lot of the capex has happened from internal accruals. Now, where I see the banks today is the first quarter is going to be tough. Second quarter could be some kind of a tough to revival. Second half of the year, I see maybe the lending growth picking up, which means from the third quarter onwards, you could see the lending growth in the banking system picking up, because if I'm betting on the private capex to accelerate, which means the private capex in absolute terms will outpace the cash flows. The moment you outpace the cash flows, that is the time you go to a bank to borrow. So I think till the time the private capex accelerates faster and outpaces the free cash flow being generated, I think bank lending growth will not pick up, and this will happen only in the third quarter onwards.
Sure, it was very fair point. Now moving on to the second part, which is like we know price is slave of earnings. We have discussed about earnings. Now, which are those sectors where the earnings expectations or the earnings reality is fully priced in, or where it is like maybe more hope is priced in, and where there is a scope where the kind of there is a definite possibility of further rise in price, because there is definitely going to be maybe a turnaround in that sector as earnings surprise, or the price to earning multiple will go up as eventually earnings will surprise. And I'm sure most of those stocks or sectors could be there in your portfolio. So it's an indirect way of understanding, where are we headed in terms of the price.
Yeah, so I think, there are some sectors where I see a lot has been priced in already. And defense is one sector which comes to the mind at the top of it, because I think people are now discounting FY28 and FY30 numbers. So when I sit with some of the analysts who are tracking defense, and, when they start talking about FY30 numbers, that gets me a bit worried. That, and you're sitting in 2025 and, we are discounting FY30 and trying to justify that, XYZ company on FY30 looks attractive. It becomes a bit kind of a difficult thing to digest. But having said that, I would say that, I am not negative on defense, but just the valuation discomfort is there. As a sector, as a theme, defense is a multi-year theme. But we all know that it makes a big difference at what valuation you enter. That really defines whether you'll make money or you'll not make money. So I would say that defense as a sector theme is definitely a 5-year, 10-year theme, but I'm not comfortable at the current valuations because a lot of what will happen in the next 1 to 2 years is already seeming to be priced in. So you could see some amount of the time correction or a price correction in the defense space for the next couple of quarters. The second sector where I see some amount of a lot has been priced in is the pharma space, where I think many pharma companies or even hospital names are looking like fairly priced in, and valuation discomfort again continues to be there. That 6 months, 9 months, 1 year back, many pharma healthcare companies, hospital names used to be fairly attractive. Now we have seen the massive rally which has happened in many of the hospital names and also many of the healthcare names. That has brought the valuations to a bit of that discomfort level. So I think these are the two major sectors where I see, which is defense and pharma healthcare, where I see a lot of valuations already pricing in the earnings for the next couple of quarters. Areas where I see a lot of growth continuing to be there, I think one is, as I mentioned earlier, is the whole power capex space. Because that is something wherein you have names which are a bit expensive, but I think growth is going to defy the broader market. So if I look at the major growth, like, you have companies in the power capex space, which for the next 4 years will give you a compounding annualized EPS growth of 50% plus. Now, if you have a compounding annual EPS growth of 50% plus from a capital good name or a power company name, definitely that will continue to see a lot of, I would say, the multiple expansion. So I think that is one area where I see. The second area where I see a lot of multiple expansion scope happening is, I would say, in the consumer staples, because consumer staples have underperformed for a long time. And I think growth is giving some early signs of picking up. And with a lot of valuation correction in many of the names, if I compare to the 5-year, 10-year average multiples, I think a lot of valuation correction has happened in many of the consumer staple names. So I think that is one area where we could see in the next couple of quarters some amount of a multiple expansion.
Sure, Aniruddha. So moving on to, what have you been doing over the last 6 months? Markets have been kind of, as you mentioned in the beginning, quite volatile. And then earnings trend has also reversed. Earning expectations are also something that you are closely watching. So in your portfolio, if I was to understand, any recent sectoral changes or introduction of new sectors, or if you want to talk about any particular stock, with a disclaimer that yes, this is entire for our understanding and education. We are wanting to kind of take your brain and understand on this Friday afternoon. Nothing to be construed as any kind of advice. Anybody who watches this webinar even later should not construe any stock or sector discussed as any kind of advice. It is all for our own understanding and knowledge.
Yeah, sure. So I think if I see the last 6 months, in fact, when the decline happened in the month of Jan-Feb, when everyone was on the edge of their seat that markets are going to tank more, the common view which we used to hear is that you sell small cap, mid cap, buy large cap. That was a common view across board, that you move to large cap, sell small cap, mid cap. I was of the view that we are actually doing more damage to investors' wealth by making these statements, because you should look at companies on their individual merit and not have a blanket statement of small cap, mid cap is bad and large cap is the good place. Just to give an indication, Nifty Next 50, which is also a large cap index, it actually underperformed the mid cap index during the decline of China. So which means the large cap index is falling more than a mid cap index during that period. Now, having said that, I think what I focused during the last 6 months is to see where the earnings growth is going to be the highest, irrespective of the market cap, irrespective of the sectors. Now, it would be very interesting to mention that I actually increased my small cap allocation, mid cap allocation in the last 6 months, purely because that is the area where I saw the highest growth also happening. So there have been names which I bought when they were small cap and now they have become a mid cap in the last 6 months. So that gives an indication that, when there is the maximum noise in the market, it's good to look at names where the growth is happening. Just to mention one or two sectors and also one or two names, and again to mention the disclaimer that this is purely for discussion and not as not to be seen as a recommendation, because we already have it in our portfolio and we would have bought for our clients at much lower levels. So two names which I'll mention from the two sectors where I've been very bullish. So one is your ITC hotels. And ITC hotels is something which I've been buying from the day it got listed. And the stock got listed at 165 plus minus. I've been a buyer since 165, 170 levels. And my view was that it was a small cap. So when it got listed, it was a small cap. Why? Because its market cap was around 30,000 crore. As per Amphi definition, anything below 34,000 crore was a small cap that point of time. And my view was that being the second largest hotel chain in the country, and coming from the ITC group, we all know that it is not a small company. By Amphi definition, it can be because of the market cap thing. But yes, by the very nature of the business, it's not a small company. Where it stands today, it's a mid cap now. So from the listing which happened over the last 6 months, from being a small cap, it has migrated to being a mid cap. We had the results of ITC hotels coming day before yesterday. Exceptional numbers. As we speak, the stock is at around 250 level. So a journey from 165 to 250 in the last 6 months, when become a mid cap. So I think we need to look at bottom line earnings. Yeah.
We lost you for last 5 seconds, but
yeah. Am I back?
Yeah, you're back. Absolutely.
Okay. Yeah. So ITC Hotel is the name which I mentioned, which we have seen strong growth in earnings, strong growth in ARR, strong growth in occupancies, and I think it is going the right way. It is following the path of Indian Hotel, and I own both of them, thankfully, Indian Hotel and ITC Hotels. The second sector and the second name which I'll mention over the last 6 months, which has added to my confidence, is the power sector, and within that, Hitachi Energy. So Hitachi Energy, being the world's largest transformer company, also happens to be India's largest transformer company. And from the point when we entered at around 8,500 to 9,000 levels, the stock has given us more than 100% kind of a return. Where I would say my confidence was, and I think that is where a lot of discussions used to happen at the point when I entered the stock, is that people used to look at the past earnings and say the stock is expensive. Now, my view was that over the next 4 years, Hitachi is doing the maximum power capex for government when it comes to the HVDC orders. It won most of the HVDC orders which were awarded by the government because it has some of the technology which no one else has in the world. And that gives it an order visibility for the next 4 years that it will have its earnings growth compounding at 55 to 60% Y on Y. So if you have a 55-60% compounding 4 years earnings growth, definitely, this is a name you would want to bet on, because there is no sector, no company which can give you a visibility of that type of an earnings growth. So I would say that, this is again something which I think, and the good part is the parent of Hitachi, after a long time, did a capex in the Indian entity, which shows that they did a 2,000 crore capex. And that shows that, this is a play which you would want to have, because if the parent is doing a capex after a long time, definitely this is something which adds more confidence that, your parent is betting on the Indian entity. And definitely with the HVDC orders which the Indian entity got, that gives you more conviction that, this is a name which you would want to bet on. So I think these are some examples of sectors I've betted more and they've played out well. I don't see a reason to decrease my exposure in either of them, because the whole thought process continues even as we speak today.
So what are those sectors where you have actually decreased your allocation over the last 6 months, or you plan to decrease?
So I've decreased my exposure in consumer discretionary because I think within consumer discretionary, I had a very large allocation, and that remained for most of FY24 and FY25. And that was some of my biggest portfolio contributor also. So from having almost 42% exposure to consumer discretionary, I have brought it down to around 30% today. So you can say that is one area where I have decreased my allocation, and that is purely because of valuation, and also because, a large part of it has already been played out. So consumer discretion is one area where I have decreased my exposure. The second big area where I have decreased my exposure drastically is the real estate, because I think the real estate is one space where, if you remember, when we used to have our discussions way back in 2020, 2021, I used to be very, very bullish on the real estate space. And I used to have almost 14% exposure in the real estate space at that point of time. From having 14% to not having any exposure today, I think that shows a big shift of my conviction in that space, because I think the sector has peaked out. Except a few pockets here and there, I don't see that supernormal growth which was visible for most part post-COVID to continue. I think price appreciation in most pockets are done. So I think now you have a very kind of oversupply also in different regions, and I think demand is also a bit weak. It might come back with interest rates going down and disposable income going up for urban class, but I think as a sector, I don't see a multiple expansion happening for the real estate. So these are the two major areas where I have seen some amount of the decrease happening, which is consumer discretionary and the real estate.
Sure, Aniruddha. Overall, you had mentioned that in the month of January, February, when there was a narrative in the favor of large caps, you actually had a contrarian view, and that worked because large caps have kind of, I would say, recovered lesser than mid and small caps. Now at this juncture, seeing the earnings, what is your view in this regards, and what's the construct of your portfolio in from this point of view?
See, even as of today, I have my biasness towards the mid and small. So around 38 to 40% of my portfolio is into large cap. 5% will be the cash, and 55% will be into the small and mid. And if you ask me breakup between small and mid, out of that 55%, roughly around 28 to 30 will be small cap, and balance will be the mid cap. The reason being biased towards the mid and small is that is where the highest amount of growth is also going to be visible for the next 2 to 3 years. See, both the names I mentioned, ITC Hotel is a mid cap, Hitachi is a mid cap. Both are going to see the kind of growth which a comparative large cap will not see. So I would say the growth visibility for the next 2-3 years the highest in the mid and small cap. My bias towards small continues.
Sure. Broadly speaking, while markets have recovered decently, we were maybe just a few percentages point below the all-time high, which was touched in the month of September. And from there, markets have again started to show, I would say, resistance, because maybe the quarterly earnings, the way they are coming, have kind of relatively disappointed. But broadly speaking, how do you read the mood and the current quarter earnings which have come so far? And do you see that the index has actually rallied, and from here till earnings actually show meaningful upside, markets are going to be range bound? Or you are of the view that kind of, as you mentioned, the earning downgrade cycle is behind us, and this is a perfect opportunity for one to ideally kind of be positive and invest at these levels?
I would agree on the last part, and I would be of that view that I think this is a period wherein the market is a bit of a, you can say, the sideways, because investors are a bit worried about what comes out of the India-US deal, what tariff numbers comes India's way, and also whether we see earnings pick up happening in this quarter. Because so far, if you look at the numbers which has come from the IT sector or the banking sector, I think it's not very exciting. But I think the better numbers will come somewhere in the middle of this kind of earning season, and that is where I would say you will get a good pickup in the market. So I would say market is a bit worried with regard to these two factors. One is what comes out of the tariff deal and whether the earnings surprise or positivity. Now the one thing which I think investors should keep an eye on is that India has been a big underperformer compared to the rest of the world. If you see in this calendar year compared to the rest of the world, we would be in the bottom quartile. So I won't say that we are the worst performing, but yes, we would be in the bottom quartile when you look at all the countries from developed to emerging and all the markets. And I think that is where I think a lot of the time correction and valuation correction has also happened. When I say valuation correction, it's not that we are cheap at 21 times 1 year forward and 19 times 2 year forward. I think we are not cheap. But definitely we are not very expensive compared to what we were early. So we earlier used to trade at 24, 25 times, and from there where we are today, I think some amount of comfort is there. But yes, I think that valuation mismatch compared to the rest of the world is something which is again hurting investors' mind. But I think that will again get addressed once the earnings picks up. So if the earnings goes back to 10, 12%, which I'm expecting FY26 to end at, then I would say that, a 24, 25p is something which the markets can start again looking at.
As a fund manager in current environment where obviously the future is far more hazy than maybe it was in 2024, though valuations have relatively corrected, but still, valuations are dependent on earnings and which are relatively uncertain. Are you not wanting to hold some cash in your portfolio? Did you take cash call 6 months ago when we were at a last bull run's peak? How do you see the entire construct of fund managers coming and saying that some fund managers like are sitting at maybe 90% cash at these levels? But obviously, most fund managers say that it is our responsibility to invest equity part of the portfolio. Cash is something which investors have to see on their own when they do asset allocation in terms of dividing the assets between equity and debt.
Absolutely.
How do you see when you get investors money, like I'm saying new clients giving you fresh money on daily basis, how do you deploy that money when you kind of take these decisions?
Yeah, so basically, I'm in the second camp wherein, I would not take very aggressive cash calls. So typically, I would say that, any new clients coming in, roughly 65 to 70% I deploy on day one. Balance 30-35% gets deployed over the next couple of months. Having said that, I would have gone up to 8 to 10% cash in the last 6 months, but not beyond 10%. And as of today, around 5% is the cash level. Now, having said that, I would say that yes, I agree with you on that part that investors, the money which they have given to us is purely for equity. Now, if we start allocating that money to cash again, then it should be more like a tactical call, not a positional call. So for me, a cash call is more tactical call, which means that around the times where a lot of uncertainty is there or valuations are expensive and you're not getting any good ideas, I would go up to 10-12% kind of a cash level. But it will not be a positional call that you sit for 6 months on 10-12% cash. I would be wanting to deploy it immediately the day I get an idea. So for me, a cash call is more a tactical call and not a positional call.
Sure. We move into the last and most, I would say, interesting and meaningful, aspect or a question. We have seen over last, say, 15 years, and that's your journey as a fund manager, maybe 10 to 15 years, whereby there was a time where pharma and consumers rallied. Those were turnaround, sectors at that point of time because they were kind of seeing for a rise in PE and they were like turning around. Then it was IT, financials, and then the last bull run we have seen come back after a long period of time of PSUs, banks, which was before 2008 era. They had kind of rallied. I remember, I had started my career in 2005, 5 to 8 rally that we saw. That was a rally which was more driven by infrastructure, government focused sectors, or maybe, power and all these. But same happened in last 4 years because obviously government spending went up a lot. So what are those new, I would say, turning around, I would say, stories or sectors or industries that you see now from here onwards? Because obviously last 2 decades of experience should lead us with some insight, because that is the only area which will actually add alpha and maybe will bring you on the top in this competitive fund management industry. How do you see that happening? Because anybody who actually was able to figure this out, that power and PSUs are going to lead last bull run, would be the best fund manager. Now, what are those insights? What are those, I would say, discoveries that are going somewhere in your subconscious mind and you are validating every day and maybe gradually building up your positions?
It's a question which you asked, which I would say is a multi-billion-dollar question, and everybody would want to know that where the big, I would say the big multi-bagger is going to come from. Now I'll answer this question saying that as of today, definitely there is no broad-based sector which is looking like very deep value sector. Now, where the multi-baggers will come from, I will say that it is going to come from different sectors. So it is not that any sector is as of today deeply valued. I would say deeply undervalued. Like PSUs you mentioned, pharma, IT, and chemicals. or I would say even the power sector or any of the sectors. There's no sector today which is very cheaply priced as a sector level. What I am looking at as of today and what I think investors should focus on is that within sectors, bottom up, there are some companies which are coming out of a long period of underperformance and a long period of inefficiencies of operations, which are becoming more efficient. So there are companies in the small cap space, and this will come only in the small cap space. You can't expect a large cap company to come out of the woods. So I would say there are many small cap companies. And when I say small cap, I'm not getting into that 100 crore, 200 crore company. So I don't look at companies typically below 1,000 crore. And between 1,000 crore and above, there are more than 1,700 companies. So I think it's a huge basket. So I think there are many companies in the small cap space which have been a big underperformer in their sector for a long time because of XYZ reasons. Could be inefficiencies of operations, could be that they were localized in one geography and now they're expanding, could be that there's some products was waiting for approval and now the approvals have come in. And this is typically what we see in the healthcare space also. Some pharma company which was very cheaply priced, and so all of a sudden some approval comes and you see the stock going up because now it's getting higher P multiple. So I would say that, you will find companies across sectors where that multi-bagger opportunity is there. So it will not be so easy. And that is why I would say that from here, looking at multi-bagger is not going to be so easy compared to the last 4 years or 5 years of easy money making, wherein the whole sector went up. So now I would say that whole sectoral uptrend is not going to be there. It will be within the sectors. You'll have to look for individual names. And that is where I think people like you and me, our job becomes more important for investors, that it is not going to be a broad-based rally, but more company-specific rally, which will happen for the next couple of years.
Sure, Aniruddha. So, I mostly agree with your answer, but I'm sure there is something which, going to come from the bottom. Maybe, not from the point of view of valuations, but from the point of view of policy changes, from the point of view of opportunity, which is coming, from macro also. I agree with you that yes, if one looks at from the point of view of valuations, yes, everything seems to be fully priced in. Only management decisions and capital allocation decisions by management can bring some turnaround in a business. But if you further think, I ask this question again, like defense, as a sector came from nowhere in the past, right? There will be something, which is happening, in terms of, because India is a developing economy and we are kind of moving from fifth to fourth to third larger economy. There's so much which is happening in India. In the listed space, there will be some industry, some sector which is turning around. If you can think of that and then maybe again try to answer this, or if you want to stick to your old answer, up to you.
No, I'll continue with my old answer that, it is going to be more company specific and not a broad sectoral thing. But yes, if you push me against the wall for looking for a sector, I think one sector which comes to mind where I see a lot of the re-rating happening is the cement industry. Last couple of years, cement industry was seeing the two things. One is price hike was not there. Second is a lot of M&A activity was there. Now, why price hike didn't happen is because the bigger boys wanted to acquire the smaller guys and they kept the prices low so that they get the companies at a good valuation. Now, most of the M&A has been over in the cement industry. Now it is like they can form their own pricing and the big boys get to share the bigger pie. So I would say the cement is one industry where I see a lot of growth happening, because if a lot of capex, infra, the real estate, all this activity will continue and you have a few players left now, the bigger boys. So the bigger has become bigger. The big has become bigger. So I think that is one area where you could see a lot of growth happening. And as I mentioned in my initial comment, this quarter also, I think cement is one industry which you'll see like, 30-35% kind of a Y&Y growth in earnings. But to be honest, I will say that, investors should look out beyond the listed space also, because I think the biggest multi-baggers are coming on the unlisted side. And when I say unlisted, it is not the big names which we keep hearing. A lot of small, mid-sized companies in the unlisted space are doing a lot of work. And I'm sure you also would be discussing many unlisted ideas with your clients. There are many Cat 2 AIFs which are actively participating there. I think unlisted space is where the big multi-baggers will also come from. and we have to look for names in sectors where the growth is happening. Defense, for example, in the listed space, I might be saying that defense looks overvalued, and but there are many good names in the unlisted space which are doing exceptionally well.
Sure, Aniruddha. So you have given the inference. We are an alternates focused platform, and obviously, we deal both in listed and unlisted, and it is like up to investors' profile, and then we have full and I would say in-depth understanding of what are the best funds and who are the most sincere and most passionate fund managers. And I see you as one of those, and that is the reason I am grateful that we have spent this almost 1 hour of very insightful and intuitive discussion. I hope we have added value. Thank you so much for joining today, and thank you, Aniruddha, for your time.
Always a pleasure.
Pleasure.
Thank you.